Welcome to Understanding Interest Rate Risk, a training module by Compliance and Risk Management at the League of Southeastern Credit Unions and Affiliates. Today we'll be diving into the essential strategies for comprehending and managing interest rate risk, ensuring the ongoing financial stability and success of your credit union. Let's get started. Let's break down what we'll be talking about today. We're going to define interest rate risk and work to understand the different types of interest rate risk. We'll also discuss elements that affect your interest rate risk. We're going to look at ways that you can measure your interest rate risk and how you can manage your interest rate risk. We're also going to consider what components are of a successful interest rate risk management program and look at how you can write your policy. So what exactly is interest rate risk? Well, interest rate risk is the potential that changes in market interest rates will adversely affect a credit union's earnings and net worth. Interest rate risk, or IRR, focuses on the repricing speed of the credit union's assets, like your loans and investments, relative to your liabilities, such as your shares and your member CDs. There are 4 types of interest rate risk that you should understand, and we'll take a chance to look at each of these, starting with repricing risk, and then yield curve risk, basis risk, and finally, prepayment or extension risk. First, let's look at repricing risk. This is the risk that assets and liabilities reprice or mature at different times, causing margins between interest income and interest expenses to narrow. A yield curve risk is the risk that non-parallel challenges in the yield curve will disproportionately affect asset values or cash flow. For example, mortgage assets tend to be priced off of 10-year U.S. Treasury rates. Suppose 10-year Treasury rates change significantly, while all other Treasury rates remain unchanged. The value and cash flows from mortgage loans will change significantly, but other assets and liabilities will not experience similar changes. In this case, credit unions with significant mortgage holdings would be exposed to greater yield curve risk than credit unions with less mortgage holdings. Basis risk is the risk that changes in underlying index rates used to price assets and liabilities do not change in a correlated manner, causing margins to narrow. For example, loans priced off of national prime rates might not change in the same manner as certificates of deposits priced off of U.S. Treasury rates. Finally, let's talk about prepayment or extension risk. You may also hear this called an option risk. Prepayment risk is the risk that asset repayments increase at a time when interest rates are low, and this can result in lower interest income and the need to reinvest repaid funds in lower yielding assets. This risk increases when members pay off the credit union's loans prior to maturity and interest rates decline. On the flip side of this, there's extension risk, which stems from the lengthening of asset payoff rates in a rising rate environment, thereby reducing the funds available to invest at higher yields. So now that you understand the 4 types of interest rate risk, you may be wondering what drives that interest rate risk. Well, there's 3 main drivers that can affect your risk. First, there's the term to maturity or repricing, and in this case, the shorter the term, the lower the risk. There's also the timing to cash flows, and what you need to know here is that an earlier cash flow will equal a lower risk. The size of cash flow also matters, and a higher periodic payment will result in lower risk. Of course, our economy is cyclical. When the economy is growing and there's inflation, the Federal Reserve will commonly increase interest rates to slow the economy. Changes in the Fed fund rates impact the credit union's assets and liabilities, as well as the credit union's bottom line. There may be times during which the credit union has not experienced any unexpected losses or changes in investments or lending policies, but it has significantly lower economic value from recent surge in interest rates. When the economy is in a recession with falling inflation and rising unemployment, the Federal Reserve typically lowers interest rates to stimulate the economy. As you consider your interest rate risk, keep in mind that the rise and fall of interest rates due to the economy can cause a mismatch to your credit union's rates, and this will affect your risk. For example, in the post-COVID economy of 2022, we experienced a quick rise to rates that we had not seen in decades. This rise caused the NCUA to warn that credit unions may experience market risk exposure to earnings and capital as the credit union's assets and liabilities fail to reprice these rates equally or concurrently. This led to a call of close interest rate risk supervision to ensure the soundness of the credit union system. You should know that your interest rate risk is tied to other risk areas, such as your credit risk, liquidity risk, and strategic risk. Let's take a moment to look at each of these. First, let's talk about credit risk. This is the type of risk relating to any contract between a credit union and a person or an entity, usually involving loans. If a member defaults on a loan agreement, then obviously this will have a negative impact on the risk level for the credit union's assets. If a credit union invests in a third party, this will also introduce credit risk. Ignoring the impact of potential IRR on delinquency can lead to severe underestimation of overall risk. Credit unions should understand that rapidly rising market rates can exacerbate credit risk exposure and should be considered in the overall risk management process when assessing how market rates threaten earnings and net worth. The next risk area IRR affects is liquidity risk. Liquidity risk is the current and prospective risk to earnings or net worth arising from the credit union's inability to meet its obligations at a reasonable cost when they come due. Put more simply, this risk relates to a credit union's liquid funding source and its ability to meet obligations as they come due. For instance, if there were a run on your institution and members withdrew as much money as they could without penalty, that drain on liquidity could hinder your credit union's operations. Changes in interest rates can impact a credit union's primary source of funding, which can lead to a strain on liquidity. Finally, let's take a look at strategic risk. This is the type of risk arising from adverse business decisions, improper implementation of decisions, or a lack of responsiveness to changes in the industry. Dealing with this risk requires the development of strategic goals and business strategies, which is something that your credit union should deal with at the executive level and with your board of directors. Any strategic business decision that alters the credit union's balance sheet composition, which includes decisions around your interest rates, can impact its exposure. But really, why should you care about interest rate risk? Well, while most credit union liabilities are short-term, fixed-rate real estate loans are long-term, and fixed-rate real estate loans have increased in some credit union portfolios over the past decade. A rising rate environment may create a margin squeeze where share rates rise while the rates on those loans remain fixed. And why is this important? Remember that a change in interest rates will affect the fair value of long-term assets more significantly than short-term assets. So ask yourself, does my credit union have the tools necessary to measure our risk while monitoring our ability to absorb those risks? To what extent is our credit union exposed to IRR factors? Have we established policies, procedures, and parameters to address our acceptable risk tolerances? It's important to keep in mind that the level of IRR exposure can represent a major potential threat to a credit union's earnings and capital. The Federal Credit Union Act, Section 201, and the NCUA Regulation 741.3, Section D, defines interest rate risk as a condition which creates a probability of loss in excess of that normally found in a credit union, and which indicates a reasonably foreseeable probability of the credit union becoming insolvent because of such conditions, with a resultant claim against the National Credit Union Share Insurance Fund, or NCUSIF. The potential significance that IRR presents makes it exceptionally important for credit unions to monitor. Each credit union will experience IRR to some degree, and management of this risk should commiserate the complexity, risk profile, business model, and scope of the credit union's operations. To this end, the NCUA has provided a number of IRR resources that credit unions should become familiar with. Measuring your IRR is an important step that helps you have a clear understanding of the state of your credit union and the risk that you face. You'll also be able to take active steps to lower and manage your interest rate risk. These are three commonly used measurement methods. However, there are other methodologies, and you should be sure that you are using whatever method makes the most sense for your credit union's size, complexity, and risk. Measuring interest rate risk and understanding your credit union's specific risk is essential to managing interest rate risk. We're going to take a moment to look at each of these methods and go over how you can use them. First, we'll take a look at a gap analysis. A gap analysis is a simplistic IRR measurement model used by small or non-complex institutions that provides an easy way to identify repricing gaps. It can also be used to estimate how changes in rates will affect future income. A gap analysis compares rate-sensitive assets, or RSAs, and rate-sensitive liabilities, also called RSLs, over a specific time period with the goal of identifying repricing gaps and to estimate how interest rate changes may affect that future income. However, a gap analysis has several weaknesses and is generally not sufficient as the sole IRR measurement model for other than small credit unions. Truthfully, this analysis type can only suffice for simple balance sheets that primarily consist of short-term bullet-type investments and non-mortgage related assets. A gap analysis can be a first step in identifying IRR exposures and may serve as a reasonable check for more sophisticated forms of IRR measurement models, particularly in those less complex institutions with simple balance sheets. Moving on, let's look at income simulation. So, a net interest income simulation is a modeling technique that projects the changes in assets and liability cash flows, expressed in terms of net interest income over a specified time horizon for defined interest rate scenarios. It provides us with a comprehensive way to stress plausible near-term earning results. This is a commonly used measurement method used to estimate earning exposure to change in interest rate. An income simulation analysis projects interest cash flow of all assets, liabilities, and off-balance sheet instruments in a credit union's portfolio to estimate future net interest income over a chosen time frame. Put simply, income simulation analysis lets you know how your income, based on current rates, would change if rates go up or down. This analysis is generally well suited for short-term time horizons as it's assumption sensitive and does become less certain for longer forecasted periods. Finally, we'll discuss net economic value, or NEV. NEV is measured by calculating the present value of assets minus the present value of liabilities, plus or minus the present value of the expected cash flows on off-balance sheet instruments, such as some interest rate derivatives. You didn't know you were getting a math lesson today, did you? You can use NEV to quantify the economic value of the entire balance sheet expressed as a single amount. Calculating NEV allows credit unions to simulate impacts for different rate scenarios and understand the potential effects on net worth. This analysis is appropriate for considering long-term risk. Net economic value measures the change in the value of the credit union's assets and liabilities due to interest rate changes and the impact that these changes have on the credit union's capital position. The NEV will give you an early warning alarm of risk within a credit union's balance sheet that could impair capital possibly 5 or even 10 years down the road. Generally, NEV computations demonstrate the economic value of net worth under current interest rates and shocked interest rate scenarios. Often, NEV is used in conjunction with income simulations to give an overall view of both short-term and long-term risk. The NCUA Asset Valuation Tables Workbook is available and prepared quarterly by the NCUA and is a helpful tool for credit unions with assets under $50 million. This analysis method provides a simple measurement of the potential devaluation of a credit union's mortgage loans and investment securities that occur during plus or minus 300 basis point parallel rate shocks. The measurement also provides an indication of a credit union's potential interest rate risk based on the risk associated with the asset categories of great concern. Another concept that we should look at is net interest margin, or NIM. This compares your net interest income from loans with outgoing interest paid to member deposits, such as those on savings accounts and CDs. NIM is expressed as a percentage and is a profitability indicator that approximates the likelihood of a credit union thriving over the long term. A positive net margin suggests that the credit union operates profitably, while a negative figure implies investment inefficiency. The figure on your screen demonstrates net interest margin, or the spread. The market controls your interest income and expenses, and you manage the spread between the two. So now that you know about interest rate risk, you understand what it is and how to measure it. How do you go about managing it? There is no one-size-fits-all answer here, but what you should know is that your actions need to match the level of your interest rate risk and be appropriate for your credit union. There are, however, common methods that you can consider. First, limit your credit union's exposure to long-term investments and loans, and balance the duration of all assets to more easily prepare for interest rate increases. Diversify investments into different categories, particularly investments that are not interest sensitive. The credit union can divest itself of investments or loans that might be more sensitive to interest rates. Also, consider adjusting your credit union's mix of assets and liabilities to reduce the interest rate risk. You can reduce option risk by controlling the terms of loans and deposits. You can also diversify the duration of investments held at any given time. Interest rate risk is not just a financial concept, it also carries NCUA regulatory requirements. Federally insured credit unions with assets greater than $50 million must maintain a written policy and effective IRR management program as part of asset liability management. Of course, credit unions under $50 million in asset size should still understand and monitor IRR and may even decide to create a simple IRR management program or policy. Now let's take a look at how you can create an effective IRR management program and have success with your policy. To create an effective IRR management program, consider these 5 things. First, you'll need board involvement and approval. The board of directors is ultimately responsible for ensuring the adequacy of the IRR policy and its limits. Approval needs to be recorded in those board minutes. Second, your board should provide oversight and ensure that management implements the program. Again, the board of directors is responsible for oversight of the credit union and for approving the policy, major strategies, and prudent limits regarding IRR. The board should ensure that management executes an effective IRR program. The IRR program should be assessed by the board annually. Third, set up risk management systems to assess IRR sensitivity. Credit unions should have IRR measurement systems that capture and measure all the material and identified sources of IRR. The measurement system should quantify the risk contained in the balance sheet and integrate the important sources of IRR faced by a credit union in order to facilitate management of its risk exposure. Fourth, create internal controls to monitor adherence to IRR limits. Internal controls are an essential part of a safe and sound IRR program. Staff responsible for maintaining controls should periodically assess the overall IRR program as well as compliance with the policy. Audits may be performed by management or a supervisory committee if an internal audit is not available. Audit findings should be reported to the board or supervisory committee with recommended corrective actions and timeframes. Finally, make informed decisions that are guided by IRR measurements. Management should utilize the results of the credit union's IRR measurement system in making operational decisions such as changing balance sheet structure, funding, pricing strategy, and business planning. This is particularly the case when measures show a high level of IRR or when measurement results approach board-approved limits. Management should also use the results proactively as a tool to adjust asset liability management for changes in interest environments. When you're creating your IRR policy, keep in mind that credit unions have the option of either creating a separate IRR policy or incorporating it into a policy governing investments, ALM, fund management, liquidity, and other areas. What is important is that your IRR policy is clearly documented in writing. While you're creating your policy, remember to include these 3 points. Number 1, be proactive. Proactively establish strategies describing actions to be considered when policy limits are breached. Number 2, raise the alarm. Your policy should address procedures for alerting senior management, committees, and the board, and to bring swift resolutions. And number 3, recognize when to make exceptions. Clearly define when exceptions to the policy will be made and what actions and authorities will be required. As you create or update your IRR policy, here are the things that NCUA wants to see. First, identify committees, persons, or other parties responsible for review of the credit union's interest rate risk exposure. Direct appropriate actions to ensure management takes steps to manage IRR so that the interest rate exposures are identified, measured, monitored, and controlled. Make sure that you state the frequency with which management will report on measurement results to the board to ensure routine review of information that is timely and sufficient details to assess the credit union's IRR profile. Also set risk limits for IRR exposure based on selected measures. Specify which test, such as the interest rate shock, that your credit union will perform using the selected measures. Provide for a periodic review of material changes in IRR exposure and compliance with board-approved policy and risk limits. Make sure that your policy provides for assessment of the IRR impact on any new business activities prior to implementation. Also ensure that you're providing for at least an annual evaluation of the policy to determine whether or not it still matches your credit union's size, complexity, and risk profile. Shameless plug, but Policy Pro is a great resource to help you build compliant IRR policies. We've talked about a lot today, so let's sum it all up. Interest rate risk, or IRR, is the potential threat to a credit union's earnings and capital due to changes in interest rates. There's different types of IRR, which include repricing risk, yield curve risk, basis risk, and option risk. Your IRR is also associated with your credit risk, liquidity risk, and strategic risk. There's various methods that you can use to measure your interest rate risk, including a gap analysis, income simulation, and net economic value, or NEV. Federally insured credit unions with assets over $50 million are required to maintain an IRR management program. When you're creating that IRR management program and policy, make sure that you're following NCUA guidelines and requirements. Do you have any questions about this or any other compliance topic? Reach out to us at compliance@lscu.coop.